From a global economic perspective, I think the consensus has been coming around to our strong growth outlook. The data is starting to confirm that as well. When we look at ISM manufacturing or ISM services in the US at a record high, we see improving manufacturing in Europe as well. Hiring intentions are very strong. The labor market data that came out were very strong. And we're ahead in the second quarter, third quarter of this year. We're going to have phenomenal growth numbers. First of all, let's acknowledge that inflation is a variable that has been historically very difficult to forecast. We must say that economists have less than an A+ rating on forecasting inflation. Second is the last 10, 20 years is probably not a good blueprint to forecast what's ahead of us because we're facing circumstances that are unprecedented in the sense that we've never seen central banks that are all focused towards growth, all keeping interest rates towards zero, and in conjunction with governments are supporting extremely large fiscal deficit that we haven't seen in a number of decades. Third is the incentive from governments is very strong towards having strong growth and inflation because of the large debt that they have accumulated. And so the one way to repay debt and lower the debt to GDP level is to have strong growth and strong inflation as a way to lower the debt burden. Because the other elements to lower the debt burden would be to reduce services, increase taxes, or even worse, default on debt, which is unacceptable from a political perspective. Inflation, we give the benefit of the doubt, at least over the next 12, 18, 24 months, that policy will be very stimulative and inflation will rise, which will lead to some investors' concerns. What we do look into of what could rise in terms of prices, we look at, for example, commodity prices have been very strong. In terms of wages, which is the key longer term, there are elements that could point towards eventually a bit higher wages. We see that Biden administration wants to raise the minimum wage. The growth in employment has been very strong. All central banks have an interest of running the economy hot and raising the employment to the maximum employment level, having an objective of reducing inequality in society today. So wages might be a bit stronger in the next 24 months. All of that points towards slightly higher inflation that we may have experienced in the last decade. So what does that mean for investors? There's a number of conclusions that are very important because this is a changing investment environment. One is if central banks are committed to maintain short-term rates anchored close to zero for a lot longer and run the economy hot, it means that the good economic news will be reflected in the midterm to long-term bond yields. So we're going to have a steeper yield curve. And with that comes a number of related conclusions. Everything that is duration-based is going to struggle a little bit more. So the mid to long-term maturities in the government bond markets is going to continue to experience a little bit of a backup. Note, though, that bond yields have already backed up. So there's less to rise in interest rates than we've already seen. So that's the good news. That being said, the backup in government bond yields will eventually provide an attractive opportunity, adding that asset class to portfolios and help balance portfolio over time. From an equity perspective, cyclicals, value, and financials, for example, benefit from steepening yield curve relative to interest-sensitive sectors and growthy sectors going forward. So that changes that investment environment. The other related element to that is the composition of the US market is more growthy oriented versus non-US. So a continued potential outperformance of non-US markets versus the US.